Lindsey, to you first, because you have a very good handle on the earnings. Overall, I wonder how much this is feeding into the selling. Yes, the Fed is front and center and higher interest rates, but there have been a lot of high-profile misses from stronger kind of growth companies like an Adidas, or yesterday, like some of those internet names. What do you make of it overall?
Yeah, that's absolutely right. And that's what sticks in our minds, right? So it doesn't feel so good. And so it impacts market sentiment for sure. But when I look at the S&P 500 as a whole, I look at Q1 earnings season. It was a really good earnings season so far. I know we're winding down here. We're about 86% of the way through. And 78% of companies have beat their earnings expectations. More than that, have beat their sales expectations, and the outlook continues to move higher, actually. So, and when I look at the stock reaction, well, some of those, especially in the communication services sectors, the stock reactions did not feel good for some of those high-profile misses. But overall, it was kind of a muted reaction when you look at the index overall. So honestly, I think what we need to do is look at where margins go from here. Is there going to be compression? Sales growth has been strong enough that it's been able to offset some of the cost pressures that companies have talked about, and inflationary concerns that they've talked about over the course of the earnings season. And we're expecting operating margins to continue to increase throughout the course of the year. And so we'll see if that continues to be the case as we get through the next quarter or so.
So just to be clear, Lindsey, you sound optimistic. Are you a buyer of some of these names that have been hit hard on better earnings and better outlooks, to your point? And if so, where are those names?
Yeah, I actually am optimistic because when I look at this marketplace, it's come down quite significantly, especially in certain pockets. And what I think is the narrative has changed for some reason to this story that slow is going to slow significantly. And we even heard that. I think people were reading between the lines from the Fed statement yesterday that they're expecting this major slowdown in growth, whether it's economic, corporate growth, or within the consumer spending appetite. And we just haven't seen it on the corporate side or the consumer side just yet. And I think technology is one area where you can pick and choose your spots. You got to look for high quality cash flows and companies that are returning capital to their shareholders. But there are significant opportunities in there. We started today, by the way. It was Amazon, it was Apple, it was Tesla that was holding the market up in the beginning of the day. That did not last. But people, I think buyers are starting to get interested in nibbling into that space.
Energy and utilities solidly higher now. Peter, you've been bearish for a long time. You finally got your big sell-off. S&P's now about 15% off the highs. Where do we go from here?
Thanks, Sarah. Yeah, no, I've been bearish since late last year, and the thesis was that the Fed was going to have to pivot and react on exactly what we've gotten, which is persistent inflation. The earnings picture, I would say, is actually not quite as rosy as Lindsey may have painted it. I think if you look at company guides, you're actually seeing a couple things. You're seeing for commodity producers in particular, even though that's the one area I actually happen to like here. You know, for Alcoa, for example, you're seeing unit volumes fall. You actually are seeing margin guides come down. And so while this earnings season wasn't horrible on its face, you know, the beat percentage is really not a very good gauge of where things are about to go. When you pile that on top of the fact that you can get a 4% yield from investment-grade corporate credit, and the earnings yield on the S&P 500 is about 5%, with the prospect of margin compression, which I do think will continue to occur as the year goes on, that's not a great picture and setup for equities. I think one of the other issues is with the 10-year at 3.1, 3.2%, perhaps, that doesn't give a lot of room for equities to rally either. And in fact, I think what happens is that the equity sell-off will reflexively lead to lower 10-year yields at some point, and a reinversion of the yield curve as the year progresses. From here, tactically, I think the market is quite oversold. Positioning is extremely bearish. And from here, I would actually expect something of a rally in the broad indices. That said, as I've been writing in the pieces, yeah, but I'm a seller of those rallies.